Hayden, no one's gonna buy your trashy van.
Hey.
It is so expensive, $8,000. This is 2001. Who do you think you are?
First off, it's not trashy. I detail it every new season. I wash it all the time. Right now the pollen is really bad, but it is worth it. It's been in my car. It's been in my family forever.
Okay, well then how about you show me the inside?
Okay, I will. See, so look, 3 rows of seats, 7 people comfortably.
Okay.
Okay? And
Wow, this is like a runway.
yeah, it's clean. Okay, turn the car on. High beams. All of that stuff. Turn signals, left, right. They all work. And then windshield wipers. Windshield wipers. And they work. And then my back windshield wiper works too. All that visibility, oh my gosh. And then the windows. Look at these windows. Look how big these things are. Look, on top of that, sunroof. Open it, cruise, come on. What's to say? Now the power doors don't work, but who needs power doors? Grow some muscles, you know? Oh, and the radio works too.
It's touchscreen and everything.
Yes. Also, the air conditioning is great in here. Not like other cars where the air conditioning kind of burns out. It works well.
Toyota theft. Okay. Crazy. Hayden, your van is not worth $8,000.
And how do you know that?
How many miles are on it?
Last time I checked, it was 230,700 something.
Exactly. Your van is a planned asset, which is an asset that is used for a number of years. Every mile you have driven affects the cost of your van, like what you want to sell it for. The car is also considered personal property.
Oh, so how much do you think it would be worth then?
Well, to calculate that, we would have to depreciate it, and there are multiple ways to depreciate an asset. First, we need to know how much the van originally costed.
In 2001, we bought it for $28,000 to $30,000, somewhere in that range.
Okay, so to depreciate your car, we're going to use the product unit method.
Okay, and what is that? I've never heard of that.
So each year you have owned the car, you have driven a certain amount of miles. And with each mile driven, you multiply that by the depreciation rate that we calculated. And the depreciation rate is calculated by taking the original cost minus the salvage value, giving us the estimated total depreciation rate expense. And then you divide the estimated expense by the estimated useful life, and that's how you get the depreciation rate.
Oh, okay. That makes sense, how I guess adding miles would depreciate the value of the actual, like the whole entire car. So what do you think I should sell it for to actually like get a good price and get a good buyer?
Probably around $1,250. The depreciation rate that we calculated would be 12 cents per mile driven. And since you have driven 230,700 some, you would multiply that by the 12 cents, which gives you the annual depreciation expense. And then for your van, it would be $27,676 and $80. But then you would take the original value, subtract that, which would you get, like the 1,250.
Oh, okay, that sounds good. Thank you.
That makes sense. I wonder what other assets a business can depreciate.
I think they can pretty much depreciate almost anything, but there are different methods of depreciation, and we already described some, but there are even more ways. Each method offers different things for businesses.
Interesting. What would be another example of an asset depreciating?
Well, a business would also depreciate their computers or tablets or the cell phones they give to their employees. Most times a computer, tablet, or cell phone depreciates in value a certain amount each year. It is not like a car where the more miles you add each year, the more it depreciates. It depreciates at a certain rate every year.
Oh, so it's like an annual depreciation expense?
Exactly. Sometimes an asset can be thrown away because after a certain number of years of depreciation, the asset is worth nothing, far beyond the salvage value. This method with an annual depreciation is known as the straight line method.
That's good to know. But why does a business even bother to depreciate things?
Let's see if Siri knows.
Siri, why does the business depreciate its asset? Depreciation is an accounting method of allocating the cost of a tangible asset over its useful life and is used to account for declines in value. Businesses depreciate long-term assets for both tax and accounting purposes.
Okay, ready? Now go. Hey, who's selling that land?
I don't know, but they should sure have it at a good price. Land is a permanent plant asset, so its useful life isn't estimated. To journalize the land that we sell, we debit the accumulated depreciation on the land, and in the general column, and then debit cash for the amount the land is sold. We then credit land in the general column. We can then calculate whether it was a gain or loss on the sale of the land.
Why don't we ask the guy selling the land some more questions? Hey, I have a question. Go on. How do you decide what you sell your land for? The land is...
Keep going.
Fine. Land is considered to be a permanent plant asset. Therefore, its useful life is not estimated and annual depreciation is not recorded for it. The book value of land is the original cost. Normally, land is sold when a building is also sold too. A separate plant asset is recorded. A separate plant asset is maintained for the land in the building. Each record is updated when a sale is made. That makes sense. I wonder what other assets a business depreciates.
A business depreciates many other things. They pretty much depreciate pretty much anything, but there are different methods of depreciation. We already talked about some, but there are even more ways. Each method offers different things for a business, and yeah.
Okay. I wonder what's another example of how you would depreciate an asset.
Well, we could.
Yeah, that makes sense. But that is just the surface of why a business depreciates its assets.
Oh yeah, it could probably be a lot more.
Yeah, so like in the book it said a business depreciates its assets to make sure their capital is correct and not overestimated or underestimated. A business wants to depreciate its assets to balance out its revenues and expenses. Depreciation also allows businesses to see if certain things are worth it or if they cost more than the revenue they bring in. A business would most likely want to change that or not buy that certain asset anymore, which just means like are they gaining or losing money.
I just found on righthub.com that depreciation is used to be an indicator of, just like what you said, of an actual value of an asset at a certain time based on its original value and annual depreciation. We want to make sure all assets are valued at their true values. We don't want to overestimate or underestimate the value of something, as we don't want to chip anyone of money or anything and all that stuff. We just want to make sure we're selling everything at a good price and that it works, you know? When buying or selling a plant asset, you have to make sure to record it in the plant asset record with each annual depreciation expense, the accumulated depreciation, and the ending book value for that year. For every asset that you sell or buy, you have to record that in the plant asset record, and that will help with your annual depreciation expense, your accumulated depreciation, and then the ending book value for that asset in that year.
After you depreciate an asset, you have to journalize it. So you would go to the general journal, and the account time will be adjusting entries, and you just put like the date in, and then you would do depreciation expense, for example, office equipment, and you would debit that, the amount, and then you would do a cumulative depreciation office equipment, and then you would credit that amount. The examples that we showed you were all a full year depreciation, but to do a half year depreciation, you would do the annual depreciation expense divided by 12 because 12 is the number of months, and then you would that gives you the monthly depreciation expense, and then you would times that by the number of months the asset is used, and that would give you the partial year depreciation expense. So example, say the annual depreciation expense is $120. You divide that by 12 because of 12 months, and you would get $10. And say you used it for 5 months, you would do 10 times 5, which would give you $50 for the partial year depreciation expense.
When there is a loss or gain on a plant asset, you have to journalize it you have to do 2 separate journal transactions, which is one in the general and one in the cash receipts. So for the general journal, you put in the date and everything, and then you have the account title accumulated depreciation, and then for example office equipment and then you debit the amount and then of accumulated depreciation, and then you either a loss or gain. A loss on a plant asset you put in the debit column, but a gain you put in the credit column. And then whatever type of asset it is, for example office equipment, you put it in the credit side. And then in the cash receipts journal you put in the month like we did before, and then you do accumulated depreciation, office equipment, debit in the general column, and then put in the cash debit you got for the asset, and then the loss or gain you put in the debit or the credit column, and then whatever type of asset, office equipment, you put in the credit column of the general column in the cash receipts journal. Some of the other methods of depreciation are the declining balance method of depreciation, the sum of years, and we talked about the product unit method, and then there's also calculating depreciation for income tax purposes on some assets, and then there's also depletion. So we are going to start talking about declining balance method of depreciation. So this is when you have your total depreciation expense and you have a constant declining balance rate for each year. So for example, if it was 40% and your beginning book value is 2,000, you do 2,000 times 40% to get your annual depreciation, and then you subtract your annual depreciation from the beginning book value to get your ending book value, and then year 2 you start with your ending book value of year 1, and then times the ending book value of year 1 times 40% to get your new annual depreciation for year 2.
Another method would be the sum of years, digits method of depreciation. So for example, you would take the original cost subtracted by the estimated salvage value, and that would give you the estimated total depreciation expense. And then you would take the years fraction, and how you do that, you would take the amount of years. So say it was used for 5 years, we would have 1, 2, 3, 4, 5, and then the fraction. You would add up the years digits, and that would give you 15. And then you just kind of switch the values. So the first fraction would be 5 over 15 because you take the bottom value, and the second one would be 4 over 15, and then 3 over 15, 2 over 15, and then 1 over 15. So then once you get the estimated total expense, you would times that by the year's fraction, and that would give you the annual depreciation expense.
So for some assets, there is a certain depreciation rate for each year for tax purposes. So for example, a depreciation rate for year 1 could be 20%, and then for the second year, the depreciation rate could be 32%, and then year 3, 19.2%, year 4 and 5, 11.52%, and then year 6, 5.76%. So then each year you do the original cost times the depreciation rate for that certain year, and then you'll get your annual depreciation.
For depletion, to find the rate of depletion, you would take the original cost subtracted by the estimated salvage value, and that would give you the estimated total value of your product. And then you would divide that by the estimated
like amount of recoverable product, and that would give you the depletion rate for the amount of the product. So for an example, if the original cost of coal was $100,000 and the estimated salvage value was $12,250, you would subtract those and you would get $87,750 for the estimated total value. And then you would divide that by that estimated tons of recoverable coal, which would be 50,000 tons. And after you divide that, you would get $1.75 for the depletion rate. And then in the journal, you would take tons of the coal removed times the depletion rate, and that would give you the annual depletion expense. Done.
So,
Depreciation
is a key element in a business and is not something that should be overlooked. Depreciation is sort of an appreciation for a business sometimes. Something else.
Hayden, what are you doing?
None of your business.
Oh my goodness. Okay.